Money, banking, and interest rates are fundamental concepts in macroeconomics, each playing a crucial role in shaping the economic landscape. This discussion will explore the nature of money, the process through which banks create money, the implications of the money multiplier, the demand for money, and how interest rates are determined in the market. To begin, the concept of money must be clearly defined. Money serves as any commodity or token that is widely accepted as a means of payment. It fulfills three essential roles within the economy: as a medium of exchange, a unit of account, and a store of value. While money was historically tied to physical commodities, such as gold or silver, modern economies predominantly use fiat money, currency that holds no intrinsic value but is accepted as legal tender by law. The value of fiat money is therefore underpinned by the trust and authority of the government that issues it, making it a flexible yet delicate instrument in economic policy. The process by which banks create money is a central aspect of modern banking. Banks do not merely store the deposits they receive. Rather, they use these deposits to generate profits by making loans. A portion of the deposits is kept as reserves, a precautionary measure to ensure the bank's stability, while the remainder is lent out. This process is governed by the reserve ratio, which represents the fraction of total deposits that a bank must hold as reserves. For instance, with a reserve ratio of 10%, a bank can lend out £900 of every £1,000 deposited, retaining £100 as reserves. This practice not only sustains the bank's operations, but also expands the money supply within the economy. The concept of the money multiplier is critical to understanding how initial deposits can lead to a significant increase in the overall money supply. The money multiplier reflects the extent to which the money supply is expanded through the banking system's lending practices. For example, an initial deposit of £80,000 in a bank with a reserve ratio of 10% could ultimately result in up to £800,000 in new deposits throughout the banking system. This process occurs as the initial deposit is lent out, spent, and then redeposited, with each subsequent deposit generating further loans. The magnitude of the money multiplier is inversely related to the reserve ratio. The smaller the reserve ratio, the larger the multiplier effect. Turning to the demand for money, it is essential to recognize that individuals and businesses hold money for various reasons, even though it typically offers a lower return compared to other assets. The demand for money is driven by three primary motives: transactions, precautionary needs, and speculative opportunities. Transactional demand refers to the need for money to facilitate everyday purchases, which rises with income and price levels. Precautionary demand is the desire to hold money for unexpected expenses or emergencies. Finally, speculative demand, or asset demand, reflects the preference to hold money in anticipation of future investment opportunities, which decreases as interest rates rise and increases with overall wealth. Several factors influence the quantity of money that individuals and businesses choose to hold. These include the price level, interest rates, real GDP, and financial innovation. While the price level affects the nominal demand for money, real demand is influenced by the other factors. As interest rates rise, the opportunity cost of holding money increases, leading to a reduction in the quantity of money demanded. Conversely, an increase in real GDP raises the volume of expenditures, thereby increasing the demand for real money holdings. Financial innovations, such as advancements in payment technologies, can also shift the demand for money by making it easier to switch between money and interest-bearing assets. Finally, the determination of interest rates in the money market is a key aspect of economic equilibrium. The interest rate that equates the demand for money with the supply of money is known as the equilibrium interest rate. If the interest rate is above this equilibrium, there will be a surplus of money. Individuals and businesses will seek to reduce their excess money holdings by purchasing financial assets, which in turn lowers the interest rate. Conversely, if the interest rate is below the equilibrium level, a shortage of money will occur, prompting individuals and businesses to sell financial assets in an effort to increase their money holdings, thereby raising the interest rate. Central banks play a crucial role in influencing interest rates by adjusting the money supply. For instance, increasing the money supply shifts the supply curve to the right, thereby lowering interest rates. Conversely, a decrease in the money supply shifts the curve to the left, resulting in higher interest rates. Understanding these dynamics is essential for analyzing the broader implications of monetary policy on economic stability and growth. In conclusion, money serves as a vital instrument in the economy, facilitating transactions, preserving value, and providing a measure of worth. Through the process of lending and reserve management, banks significantly expand the money supply, a process amplified by the money multiplier. The demand for money is shaped by various economic factors, and interest rates emerge from the equilibrium between money demand and supply. Together, these elements form the foundation of macroeconomic analysis and policy-making, highlighting the intricate balance required to maintain economic stability and growth.